Morning, good afternoon. Crude getting hit this morning. Metals are up, bit mixed in FX, reflecting a slightly risk-on mood from Asian equities. Shanghai Shenzhen is down. Might be a bit of news flow from there. Not sure. Didn't notice anything particularly big. I don't think there's too much in terms of news flow to get through. We have we have UOM this afternoon, or this US session, and yeah, that's about it. I mean, the only thing that can really kind of provoke a dollar rebound, a meaningful one, would be UOM, but that's a very high bar because again, there's some reliability issues with the UOM as well. So unless it's like smoking hot, it's probably going to be a little bit of a nothing burger. So yeah, let's have a quick look at what's been going on in the news. So yeah, this whole Charlie Kirk thing is going on. They haven't found the guy. He's still at large, and they're still looking for this dude who's wearing glasses, and he doesn't really look like a military dude, does he? Kind of expected more of, it really does look like an assassin. They're all very slender, kind of build in the movies and stuff, but I kind of expected someone who looked like he was in the military a long time or something. And anyway, the US is trying to put more pressure on Russia. ECB yesterday, they revised up their near-term growth and inflation forecasts. It's leaning a little bit hawkish, and the Guard was also slightly hawkish too, reiterating that prior meetings, the risks being more balanced from being to the downside previously in the last meeting. She basically reaffirmed that case, that it was based on the EU striking a trade deal or not, whether there would be a prolonged trade war or not, with retaliations and so on. And since we didn't have that, she saw risks as more balanced, and that's how they assessed it. Is the market overreacting to those signals and taking it as something hawkish? Possibly. But there's a lot in the price. But, it was generally a nothing burger, slightly hawkish, very, very slightly. And then, some other headlines. The IMF saying U.S. economy showing strains, tariffs pose risk to inflation. Yeah, we've seen all this, and then we've seen the CPI yesterday, which we'll dive into, and then soft jobs data, which we'll dive into as well. Firstly, the jobs type of data. Initial claims, the weekly number rose to the highest since October 2021. So that's probably a slightly alarming statistic. But when we look at the non-seasonally adjusted number, we're still down at these low levels, right? So when you look at all this whole range, it's looking okay. It's not looking like anything is particularly cracking yet on a non-adjusted basis. And then you have this adjustment. Now, what I think is happening, it looks like they're trying to overcompensate for the seasonal declines that we've seen, around this time of year, right? If you look here, right, from July to October, we had a nice, strong seasonal decline. And then again in 2023, again in 2024, again in 2025. And because these seasonal drops were so big, I think they're trying to overcompensate. And when you look at it, the actual seasonal decline so far has not been as big as the previous years too, right? So my contention would be here is that they're overcompensating for the seasonal decline that we tend to see here. And therefore you see a bigger than expected jump in the seasonally adjusted number. That's kind of my theory here. But we'll talk a little bit more about that in a second. CPI, hot. This was on the hot side. This was not a report for the dubs. It is not the report for those looking for 50 basis points of cuts. When you have inflation reaccelerating like this, it just does not make any sense. So, still in that camp and still trying to play into those risks. You look at food. Food is, food and energy. They're very volatile items, but I wanted to look at this because, inflation problems usually start from these volatile items, food, energy, goods. And then whatever lingers goes into services, and therefore, core CPI, core PCE, those metrics become more important in terms of gauging how sticky inflation is. But when food and energy is coming back and kind of you're seeing some price pressures there, it's never good for the overall inflation picture. And this is flagged in the chat earlier. This is just one part of it, right? There's much more to this picture than just recreational goods and furnitures. There's been a lot of front loading perhaps as well to get ahead of the tariffs, right? If you look at this, the 2025 curve, the purple one, right? We've seen a strong up move at the beginning of the year, and same here. And, that could be related to some anticipation of tariffs and trying to get in ahead of it, be okay with some early price rises rather than suffer whatever uncertainty there is later. So, yeah, all this stuff has to be taken with a pinch of salt. It could be cut in several ways, in my opinion. And if we look at, other food, this core, this less food and energy, that's a strong impulse, right? 3.6%, 3.6%, 3-month annualized. So yeah, should the Fed be cutting? Again, doesn't support that case for at least, definitely not for a 50 basis point cut. New vehicles, seeing a little bump up, still relatively muted, but and then apparel, this trend, right? It kind of fits in with that the chart that we saw before and getting ahead of the tariffs early on. This was a good podcast. I haven't listened to it all. I just listened to the start, in fact, because I just saw it this morning. I think it just got released, just only hours ago or something, not long ago. But good podcast, Monetary Matters. Jack Farley, always interesting conversations going on with people who know what they're talking about. So yeah, highly recommend looking this one up and getting into it. There was a few bits that I heard that I wanted to just highlight, which I think, is basically what we've been kind of has been our assessment too, right? What he said was, we probably won't have consumer-induced weakness, right? This guy is a cycles person, and business cycles. He's totally data-driven, really gets into the good detail with his analysis, and not just some flimsy yield curve and all this cycles type nonsense with housing and stuff. Really gets into the weeds, like cycles being business cycles, economic cycle. So when you think about our macro regimes indicator, that's one of the components that we look at, right? What's growth doing? What's inflation doing? What's both of those in short term and long term, and therefore front end, long end. And when you see those relationships play out, you get a good picture of what part of the cycle or what kind of cycle environment the market is trading in terms of growth expectations, inflation expectations, and policy expectations at the front end as well, in response to all that complete macro picture. So we've been maintaining that U.S. economy is in good shape. We know that U.S. households are in good shape. Household spending is fine. It's not falling off a cliff. Household leverage is low, right? We don't have this crazy problem like you had in the GFC when household leverage was so high, home prices decline, and that would just bust people because they were so over leveraged and overly tied to house prices that their household equity goes negative, right? So we don't have that at all. And he also said, and probably not even a consumer-induced window of vulnerability. Labor market weakness concerns is not typical of this business cycle, of a normal business cycle. They're from slowing immigration, right? So there's a lot of potential misinterpretation of the labor market right now, and we've been going through that in some detail as well, right? And yeah, this is just to show that household spending is fine, consumer spending is fine, despite your doomers on X always posting stuff about delinquencies all the time. and house prices declining outside the top 10 cities, and like it's going to crash the economy or something. But yeah, it's fine. Take a look at cross markets. Well, risk the F on. So far, this weekly performance, as of yesterday close, just Australian ASX in red, and everything is pushing for weekly gains. Even Europe, there's just a lot of uncertainty around Europe. Germany, kind of still not really kind of picking up. In France, obviously, with their issues, political issues, as well as the debt issues. So, but yeah, generally, markets are looking very strong. US, also the weekly performance so far this week, growth tech still leads the way, mostly green. Ignoring the Mag 7 stocks for the moment as we try to get the right, gauge the flavor of the market. Just staples is kind of faltering, which is quite normal when you have a very risk-on environment. Yeah, but everything else is green, right? So growth leading, and it's mostly centered around large caps as well. But there is a little bit of narrowness, right? Because if you look at the XPX equal weight, it's not fully, there hasn't been full participation, as we've been noting, right? That breadth has been quite narrow, but it has been broadening out a little bit lately. So if we look at what's been happening more recently, we're seeing small caps outperform the large caps, value outperform growth. Some of these laggards earlier in the weekend from the week before, they're all starting to perform strongly and also above XLK technology. XLY rebounding strongly, and that's probably to do with Tesla. Up yesterday, 6%. Very, very positive, and we're seeing that broadening out. So markets are finishing on a very, very strong note. And I'd have to say, however, that this week has gone so smoothly that, from my experience, that makes Friday trading all the more tricky, because you either have this momentum continue, or you have that sort of profit-taking, rebalancing kind of day. And so you get like a bit of a choppy day, right? And that's, part of being a good trader is getting a good feel for risk sentiment, risk assets, what they're doing, and looking also at the nuances of that risk sentiment as well. Like what the market profile dictates that we go long Aussie dollar, long Kiwi dollar, long odd yen, long Kiwi yen, short euro odd, short euro New Zealand setups. But Fridays, when you had this strong kind of run and performance, Fridays can be a little bit tricky. So the bias is definitely long Kiwi, long odd yen, things like that. But you gotta, there are quite a lot of traders that avoid Fridays altogether sometimes, because they can be very, very choppy. So yeah, it's I think it's going to be a tricky session based on that. So yeah, gonna keep a close eye on what ES is doing, what the 2 years doing, 10-year, and oil, gold, etc. So I think it's gonna be a tricky day. So commodities, yeah, oil kind of finishing the week heavy. Metals are looking quite constructive lately. Yeah, it's a little bit of chop yesterday. Crude, I still think these are good levels to get involved. I just don't see a good reason anymore. Just the way it's trading, I've been very, very discouraged after getting stopped out after a decent start. So, yeah. But copper, iron ore, it might be down here, but the range is higher, so it's still looking okay. And then dollar trading weak, and its neighbor CAD, worst performers of the week so far. Euro and pound also weak, which is synonymous with your risk on environment, right? Where you see your Aussie, Kiwi, SEC, NOK trading stronger. Even euro outperforming pound to the downside, pound outperforming the euro, which you would normally see in a risk on sort of environment too. But something we haven't seen a lot in recent I don't know, the last 6 months or so, euro has really had a strong positive risk premium in the price. So part of why I think it's a tactically bearish situation. Looking at yesterday's performance, quite similar to the weekly risk on profile, etc. Fridays can be tricky though. So that's kind of it. I think the main thing, I'll drop the link for the Monetary Manners podcast. I think that was really the thing we have to keep in mind amid all this news and chatter about delinquencies and so on. Yeah, it's bogus, man. The economy is doing fine, and I think this middle line says it all. Just doesn't see it. The data is not showing that the consumer, the households are significantly weakening. Right, there could be some slowing, but it's we also saw retail sales and card spending from here pick up a little bit, right? So he doesn't see any consumer-induced weakness, which is what you normally need to see during a normal business cycle, right? It has to be consumer-led for there to be this downturn, this cyclical downturn, but it's not there. And then, he's saying that there's a very different picture from spending and employment. Spending is saying one thing, employment saying the other. But then we know that employment, there's a lot going on there. And when you take a lot of things into consideration, it's probably not all that weak at all, right? And consumer spending is holding up. So that's kind of telling you that, actually things are probably fine. If there was really a problem with the employment picture, then spending wouldn't be. Consumer discretionary also outperforming. Yep, if consumer is weak, that wouldn't be happening. Exactly. Obviously, a lot of the forward guidance and the higher earnings guidance and revenue guidance is coming from tech and AI-related spending and capex in demand to keep growing. It's still a big contributor to growth. And Angus was mentioning in somewhere that just because it's just concentrated into AI and these data center buildouts and it's not really happening anywhere else, doesn't mean it's other parts of the economy suffer. No, they actually, there are some benefits, right? Second order benefits from the local communities getting more business, people who are actually making more money, going out and dining out and eating out and spending and whatever in that community. So there are some positives to come out from that. And also manufacturing, it's rebounding, and that's been a very lagging part of the economy, which the Prometheus macro guy mentions. So yeah, I think what's been discussed here is, parts of what we've been discussing too, but this sums it up quite well. Dollar yen as well, still good levels, right? Playing off the 147.15, the 147 level, it continues to work. Okay, fine. When it doesn't work, you go into the 146s, but still, there's some very solid support there. So sure, there's some, a decent revenge trade in there somewhere. But yeah, continues to trade like a champ, despite expectations moving against his favor. I'm still holding up fine. So still like it on dips. We get a dip to, that 1535 area now probably is probably a good place to load up. Yeah, I mean, ignore that. I mean, I think it's fairly clear that 147 area is just rock solid for now, and something really needs to change. So yeah, those are the things I like. Kind of risk off, tactical risk off, kind of leaning today. So yeah, let's see how we go. All right, thanks for tuning in. We will talk to you guys in chat. Thanks.